availability of resources. These are resources. These resources could be financial resources. These resources could be human resources. So the availability of resources can determine the extent of tests of control. If there are no sufficient resources, then the tests will be few. If the resources are available, then the company can perform many tests of control. So availability of resources is an obvious factor to consider by an audit engagement team when determining the extent of tests of control to be performed. So these are 8 factors. You are to give just 6. I've given you 8. 1, 2, 3, 4, 5, 6, 7, 8. Any 6 would earn the 6 marks. 6 marks. I'll now move to answer the last question of this part. Highlights 2 features of non-statutory audit. Features of non-statutory audit, part C. Features of non-statutory audit. Statutory audit, these are audits that are not required to be carried out by law. So what are the features of non-statutory audit? Features of non-statutory audit. We know that audit is not a legal requirement for all organizations. There are certain organizations that are not required by law to carry out audits, financial audits. But the question now is, what are the features of non-statutory audit? One feature is that the nature and the scope of the audit, the nature and scope of the audit, the nature and scope of the audit is determined by the audit client. Is determined by the audit client. If it's a small company, like say a sole proprietorship, audits that are carried on sole proprietors, there are non-statutory audits. So the audit, the extent and the scope of such an audit is determined by the sole proprietor, as opposed to statutory audit, where the scope and the nature is determined by law. All right? All right? Is that clear? Another feature is that this audit, the audit can be carried out, can be conducted any time. A non-statutory audit can be conducted any time, as opposed to a statutory audit where the law stipulates clearly when the audit ought to be done. For example, an audit of a sole proprietorship can be carried out any time, can be towards the end of the year, midstream, or any time, because there is no law that regulates the conduct of non-statutory audit. Another feature of non-statutory audit is that the auditor is required to, in a non-statutory audit, the auditor is required to conduct his examination within limits determined by the client. Okay? The auditor, I repeat, is required in an non-statutory audit to carry out his examination within the limits. Audit limits are determined by the audit client. The limits are set by the audit client, as opposed to statutory audit, where the limits are set by the law. We can also say that non-statutory audits are voluntary. It's not a legal requirement. No, they are done voluntarily. They are conducted voluntarily. So these are 4 features. I've given you 4. Question required to just to have 2. 1, 2, 3, 4. Any 2 marks? Yes, 2 marks. Any 2 features here would earn the 2 marks. Thank you for attending today's revision session. I'm happy to have you in this forum. In our next session, we're going to answer question number 2. Remember, we're reversing the paper that was done in September 2021. Bye-bye.
How are you, learners? It's another time that we are meeting so that we can progress with our revision. And remember, we are revising November 2019 sitting. And today I would like us to look at question number 4. Question number 4, that is November 2019 question number 4. Question 4, we have part A and part B, and we are going to start with part A. So part A reads like this. Adabil Sain is a retired engineer. He set up factory complex in an industrial area on 30th September 2017 to fabricate mechanical and auto spares at a cost of 48 million. However, operations commenced on 1st January 2018. The cost comprised the following. So we have factory building, office within the factory building, reinforcement of concrete floor to affix the factory, the machinery, land, architect fee, parking bay, electrical wiring, conveyor belt, lift and escalators, special shafts for lifts. He also provided the following additional information. Number 1, additional structures and works constructed and utilized from 1st January 2018 were as follows. So we have residential house, workplace nursery, a drawing and design room. Number 2, to improve the performance in the factory, an Oracle database that provides crowd service was constructed at a cost of 450,000. The computers in the drawing and design room had computer-aided design CAD application installed at a cost of 270,000. Number 3, a building that has been constructed at a cost of 12 million was leased from Jaram Manufacturers Limited for 5 years. The annual lease rental were agreed at 2.8 million. Nabil imported processing machinery from China at a cost of 5.2 million and installed in the building. Number 4, 2 warehouses were constructed at a cost of 2,250,000 and utilized from 1st September 2018. Number 5, the following assets were purchased or constructed during the year. We have furniture and fittings, including 220,000 for the workplace nursery, library, display furniture stocked with mechanical engineering volume, computers and electronic adding machines, motor vehicles, lorry, tuk-tuk for the messenger, backhoe loader, additional processing machinery, and mobile clean. Required capital allowances due to the bill for the year ended that was December 2018. This is about capital allowances, and as we know, capital allowances are many. We have more than one, and it depends now on the investor that you are provided with. So the investments that are done, they are the one that guide somebody when computing the capital allowances. For instance, if you have done an investment of a factory, then ID, investment deduction, need to be calculated. If we have invested in computers, then we need to know that again, we need to calculate wear and tear allowances. So because there are many, we are supposed to be guided by the investments that are done. So let's see the capital allowances that we are supposed to calculate at this point. So let's start with ID 2018. So we start with particulars, qualifying cost, and ID 100%. The items that qualifies for ID in my question, the first one is factory building. Factory building, and this factory building is costing 18,750. 18,750. 18,750. The second one is office, which is within the factory building. If the office is within the factory building, it can qualify for ID or IBD. So if its cost compared to the total cost of the factory building is less than 10%, then it qualifies for ID. But if it is more than that, then it qualifies for IBD at a rate now of 25%. IBD at a rate of 25%. If you take 6250, you divide by that total, outright you find that this is more than 20%. It's more than 30%. And therefore, this one will not qualify for ID. It will go to IBD. Then we have the third one, reinforcement of concrete floor, that is ID, concrete floor. And this concrete floor is 1650. 1650. 1650. The other one is land. Land does not qualify for capital allowance. Architect fee ID. Architect fee, that is ID 2430. 2430. Then we have parking bay ID. Parking bay, that is ID 990. 990. Then we have electrical wiring ID. That is ID 1480. 1480. Conveyor belt again is ID. Is ID, that is 1200. 1200. Lifts and escalators, that is WTA class 4. Special shafts, that's ID. Shafts, that is 3250. 3250. Additional note, the bill provided the following additional information. So we have number one, this is about industrial building, so that is IBD, and I want ID, so I skip that. Number two is about computer softwares, so they qualify for WTA at a rate of 20%, so I skip that. Number three, a building that has been constructed at a cost of this 12 million was leased, so we cannot get ID on that. But we imported and fixed a processing machine. So we have processing machine on this building, which costed 5.2. 5.2. So that qualifies for ID. Number four is about IBD. Number 5, furnitures, that is WTA. Fixtures, WTA. Computers, WTA. Motor vehicle, WTA. Lorry, WTA. Tuk-tuk, WTA. Backhoe loader, WTA. Additional processing machine. Additional processing machine. Again, the ID, that is 9 million. 9 million. Mobile crane is WTA class 1. So, allow me to go to IBD now. IBD. So, this is total ID for 2018. So, allow me to move to IBD 2018. IBD, again, we are supposed to maintain a number of columns, and they are as follows. So we can have like particulars here, qualifying cost, rate, then IBD. So those columns are enough. So let me start with the one that is in the list, that is office. Office 6250, but I will calculate its IBD at a rate of 25%. So it is 6250. We multiply by 25%. 1562,500. 1562,500. Then from there, the other form of a building is not one. We have residential house. Residential house 960. This is 10%. 10%, so 96. Then we have workplace nursery and design room, which is 1200 and 720. So 10% again, 10%. So this is 120 and 72. 120 and 72. Number 2 is about computer software. So that is WTA. Number 3, we are done. Number 4, we have warehouses constructed at a cost of 2250. So we have warehouse 2250. Warehouse 2250. The rate is still 10%. But these warehouses, they were used from September. So we have September, October, November, December. So those are 4 months. September, October, November, December, 4 months. So 2250 times 10% times 4 divided by 12. So this is 75,000. 75,000. So according to me, those are the items that I can see, which again qualifies for IBD. So I go to the total. So total IBD for 2018. I'm free to move to WTA now. We have WTA 2018. So we can create the following columns. Particulars. We have class 1 at a rate of 37.5%. Class 2 at a rate of 30%. Class 3 at a rate of 25%. And class 4 at a rate of 12.5%. When calculating WTA, we normally start with opening balances if they are there. If they are not there, you ignore. In my question, we are starting this company afresh. So I have to ignore them. So the first item, I have lifts. and escalators that are costing 4 million. That is WTA class 4 million. Then from there, note 1 or note 2, I skip. Note 3, I skip. Note 4, I skip. Note 5, I have furniture. Furniture that cost 620,000. Then I have fixtures that cost 480,000, still class 4, for 80,000. Computers and adding machines, this belongs to class 2, 840,000. Motor vehicle, so these are class second-hand BMW, this is class 3, and this is a non-commercial vehicle. So non-commercial vehicle, the price should be restricted to 2 million. Lorries 4 tons, this is class 1, 1.8. Tuk-tuk is class 3. 180. We also have backhoe loader. This is a heavy earth moving equipment that is self-propelling, so class 1. Heavy earth moving equipment that is self-propelling. And we have also mobile crane, which is also a heavy earth moving equipment that is self-propelling. So do I see any other item that qualifies for WTA? Any disposal? The answer is no. No. So what we need to do now, because if we had the disposals, we have to less. Now that we don't have disposals, so we just get the totals. The first one is 1800 plus 3680 plus 1900, 7380. So 814. 2 million plus 180, 2180. So 4620. 4620 plus 418. 4620 plus 418. I will get 51. So then we calculate WTA 2018. So we have 7380 times 0.375. So we have 2,767,500. So balance is 7380 minus that, you get 46,500. The second one is 840 times 0.3. You get 252. So 840 minus that, you get 588. 2180 times 25%, you get 545. So difference 2180 minus that, you get 1635. So 5100 times 12.5. So you get 637,500. So 5100 minus 63, 637,500, you get 44,62,500. And remember, we are calculating capital allowances. So what we want is these figures. So we don't, these are balances of the values of the assets remaining after capital allowances. But what the examiner wants is this capital allowance. There is also capital allowance relating to note number 2. That is computer software. Computer softwares. So computer software. Computer software, we calculate it at a rate of 20% times into bracket 450 plus 270. So the computer software, it will be equal to we have 450 plus 270, you get 720 times 20%, you get 144. So computer software, so we calculate computer softwares qualifies for capital allowance at a rate of 10%, at a rate of 20%. So we can finalize. So the totals are, we have 18,750 plus 1650 plus 2413 plus 990 plus 1480 plus 1200 plus 3250 plus 5200 plus 9 million. We have 43,950,000. Then you have 16. Sorry, that is 1562,500. 1562,500 plus 96 plus 120 plus 72 plus 75. I have 1,925,500. So that is the capital allowance. So in my question, we had 3 major capital allowances. That is ID, IBD, and WTA. And that is what we have just done. So allow me to move to part B of the question. It reads like this. The following information has been extracted from the records of Leatherman Limited, who are regional suppliers of electronic equipment and appliances, for the year ended, that was December 2018. So you have operating profit before tax and other incomes, investment income, leasing of electronic equipment, and we have rental income. Additional information is also provided. Like we have investment income comprising interest income from Post Bank, fixed deposit account with Loada Bank, savings account. Then we have dividend from B&M Company Limited and Kampuni Sacco Society Limited. Number 2, we have rental income is arrived at after deducting the following expenses among others: mortgage interest on property, purchase of water meters, caretaker salaries, displacement of iron sheets with roofing tiles, withholding tax on rental income. The following expenses were considered before arriving at the operating profit before tax and other incomes: salaries and wages, retirement fund contribution, depreciation, bank interest, provision for bad debts, legal and professional fees, repairs and maintenance, salary expenses, donations, compensation, instrument tax paid for the previous year. Then construction of the watchman booth at the gate. Number 4, salaries and wages comprised of directors' allowances 300,000, directors' watchman salary, and salaries to other staffs. Number 4, bank interest include that of an overdraft taken by senior manager of 40,000 on the managing director residential house mortgage of 6,000, and the rest loan belong to the bank. Provision for bad debts is also analyzed, whereby we have this analyzed figure that was posted to the income statement of 10,000. Number 7, we have legal and professional fees comprise correction of trade debts, renewal of lease 99 years, accounting fee, audit fee, tax appeal, and staff loan collection. Audit fee relates to an inquiry by the Revenue Authority which revealed discrepancies that led to higher tax liability and penalties. Number 8, sundry expenses constitute staff Christmas party of 17,000, tax of 17,000, tax penalty for late filing of 3,000, school fees 40,000, and other allowable expenses of 90,000. School fees was for the director's son, and the company agreed not to debit in the income statement. Number 9, donations were to the county governor political party campaign kitting. Number 10, compensation was to staff member who had not been issued with safety equipment and uniform as he carried out at the current premise, leading to him being badly injured. For 10 marks, the adjusted taxable profits. So, this taxation of a company, again indirect method. So what we are going to do, so we have Latheran company computation of taxable profit or loss for the year ended that 1st December 2020. So that is 2018. So you have particulars and we have sharings here. As I have said, these items are given after reporting an accounting profit. So the operating profit or accounting profit is amounting to 3.8 million. So as usual, we add back disallowable cost. Add back disallowable costs. These disallowable costs, if you start with note 1 is about investment income, so no expense there. Note 2 is about rental income, again no expense there. But number 3 is where we have expenses, and we have salaries and wages. We know they are incurred purposely to generate the taxable income, so it is allowable. Retirement fund contribution is also allowable. Depreciation is not allowable. Depreciation of 400,000. It's not allowable. Then bank interest 180, that is normally allowable. But note 5 says bank interest include that of an overdraft taken by senior manager of 40. So that is not allowable. So bank interest relating to senior manager, that is 40. That 40 is not allowable. Then and on the money and the one relating to residential house, again not allowable. The one relating to residential house, so of 60,000, again that one is not allowable. It's personal in nature, that is why we are not allowing it. Provision for bad debts, we have the analysis at note number 6. At note 6, we have bad debts written off, which is allowable for customers, but for staffs it's not allowable. Bad debts relating to staffs, that one we cannot allow. 14,000. The other thing is under this provision, and we know provision, we need to know whether it is for general or specific. If it is for general, remember it is not acceptable, but for specific it is acceptable. if you look at the provision brought forward, which is for general, 3% of the account, that means it's general. We started with 8, but when clearing at the end of the period, we have 9. So there is increase in general provision of 1,000 because it is 9 minus 8, which is 9, which is 1,000. Then I progress. Legal and professional fee. Legal and professional fee normally it is allowable. But when you go to note number 7, we have some disallowables there. It's analyzed at note number 7, whereby correction for trade dates, that is allowable. Renewal allowable. Accounting fee is allowable. Audit. But audit, if you look at that paragraph immediately after that, it says audit fee related to inquiry by KRI which revealed discrepancies that led to higher tax liability and penalty. So that audit fee, then it will not be allowed. Audit fee. But normally, audit fee is allowable. If you come across it, it is an allowable expense. Tax appeal is not allowable. Tax appeals, 30,000. Staff loan correction, no. Staff loan correction. Staff loan collection. Staff loan correction, that is 5,000. But if it is to customers or clients, that is allowable. That is allowable. From there, we go to repairs. And the repairs are normally allowable. We have also surgery expenses allowable. Donations, under note 9, we are told that donations were to county government political party. No, donation to political party is not allowable. Donations. But if it is donations to registered charitable organization, that is allowable. Like donation to Children's Home, Red Cross, AMREF, those ones they are allowable. But political party, no. So these surgery expenses is also analyzed at a note number 8. And it reads like this. Surgery expenses, remember normally it is allowable. But you can include something there which is not allowable. For example, surgery expenses constitute staff Christmas party, that is allowable. It is allowable in the company, so you tax the staffs. Tax penalty. Tax penalty is not allowable. Tax penalty. Tax penalty of 3,000 for late filing. School fees 40 and other allowable expenses of 90. School fees was for director's son and other and the company agreed not to debit, so it was not subtracted, so you cannot add it back. So the other one is compensation. Note 10, compensation was to staff member who had not been issued with safety. That is our fault, so we cannot allow that. Compensation of how much? 92. 92. Construction of watchman booth at the gate, so that is not allowable. This is a capital cost, which is 240. That's a capital cost. Any other disallowable cost? Any other? Bank interest. Salaries. But salaries not for comprise of director's allowances allowable. Director watchman salary. Director watchman salary. This is allowable in the company. Then we tax the director as part of the income. And staff and salaries to other staff. That is also allowable. They are helping us to generate the taxable income. So that is the end of the disallowables. So allow me to go to I raise capital allowances. I don't see any asset around. So we don't have capital allowance. But we have now incomes. So we less. We need now to less. We less the non-taxable. And in this case, we will not less them in fact because they are not included. So we need to add them because they have not been included. So what we need to do is to add them. So the first one, we have rental income. Rental income, in this case, rental income under note number 2, we are told that it was subject to a withholding tax. And we know very well, rental income subject to a withholding is subject to a withholding tax. Rental income that is less than 10 million per annum, but above 144,000 per annum, it is subject to a withholding tax of 10%, which is final. This was subject to a withholding tax of 10%, which is final. So it is not taxable. We just need to leave it like that. But if it was above that, we need to take the incomes, we less the costs. So we move to the other income, the other item, which is dividend. These dividends, we have dividend income, and that is investment income. And this investment income is analyzed at a note number 1, whereby we have interest from post bank. Interest from post bank. Interest from post bank is subject to a withholding tax of, is tax exempt. Interest from post bank. So I can analyze this and investment incomes. So we are saying for rental and investment income. For rental income, we are simply saying that 10% withholding tax is final. So because it's paid every month. Then we have leasing income is taxable. Leasing income is taxable, which is 50,000. That one we tax. Then we go to interest income. Interest we have from post bank. Post bank. This is tax exempt. Tax exempt. From fixed deposit. Fixed deposit. Remember, interest received by companies, withholding tax is not final. So this one from fixed deposit, 246,500. 246,500 we multiply by 100 divided by 85. That is taxable. And again from savings, which is 170 times 100 divided by 85. We are doing that because we tax the gross, not the net. Then from there, we have dividend. This dividend received from companies or circles, 5% withholding tax is final. So they are not taxable again. So we have 246,500 times 100 divided by 85. You get 290. This one is 170 times 100 divided by 85. You get 200. So we don't have any other income. So we get the taxable income, taxable profit for the year. Taxable profit for the year. Just confirm everything. So we have that. So now we can just get the taxable income. So we have 3.8 plus 400 plus 40 plus 60 plus 14 plus 1 plus 15,000 plus 30 plus 5,000 plus 150 plus 3,000 plus 92 plus 240 plus 50 plus 290 plus 200, you get 5390. And that is the taxable profit. If you ask me to get the tax liability, this is a company. So tax liability, it will be 30% times 5390. So times 0.3, I get 1670. Because companies are taxed at a corporate tax rate prevailing in the year of income. So I just multiply that one by 30%. That is for resident company. If it was a non-resident company, we tax it at a rate of 37.5%. Now we come to the end of our question today. And as usual, I will give you the assignment. Remember, for the purpose of proper preparation, we need to do more and more questions. So what I would like you to do is I will give you assignment from our revision partner so that you can revise on your own. In our revision partner, we are under the topic of taxation of incomes of persons. That is employment income and business income. So I'll expect you to address like the following questions for practice purpose. That is May 2014, question 3A and C. That's about taxation of partnerships. We also have that is partnership, that is December 2013. But we have a company, that is December 2013, question 2A and C. Taxation of Light Traders Limited, that is a taxation of a company. So you can also attempt that on your own. Yeah, there is also another question. December 2012, question 2 is about Lemuru Enterprises Limited. So can you do that for practice purpose? This is what we have done about taxation of companies, but can you attempt that for more and more practice? So that marks again the end of our class today. So let me stop my class at that point. We meet next time so that we can proceed with the blocks. So thank you.
Hello candidates, welcome to Manifested Publishers eLearning portal. Today is a new session. We've been doing question number 1 and 2. Today I'll introduce you to question number 3 of the same paper, that's May 2021, of Management Accounting. So my name is Celestine Wadabusi. I instruct you to have calculators so that we'll work together as we move on. Question number 3 comprises 2 parts. We have part A and part B, and part A reads, describe the 3 main stages of the activity-based costing. That is ABC system. What are the 3 main stages? Part A of question 3, 3 main stages. 3 main stages of activity-based system. So the 3 main stages include Roman 1, organization of the major activities. Organization of the major activities of an organization. Then stage 2, determination of cost drivers. Stage number 3, collection of costs into cost pools. And I can add you one more stage, absorption of service costs, to production departments. So in ABC costing system, we assume that there are activities that cause cost to be incurred. So the first stage in activity-based costing is identify these major activities assumed to cause cost to be incurred. So once you have identified these major activities that are assumed to cause cost to be incurred, we collect them. Those that are of the same nature are put together into what we refer to as cost drivers. And therefore, our second step is determination of the cost drivers. Cost drivers is a group of activities that cause cost to be incurred. Once you have determined the cost drivers, the next thing is what are those costs that are incurred when these activities work. So we determine what we refer to as cost pools. A cost pool is simply a collection of costs that is associated to a specific cost driver. Like when we have activities of, we have a group of activities that is causing cost to be incurred, and then we identify the related cost to those activities into one group. We refer to that as a cost pool, which is our stage number 3. And once we've determined the cost drivers and cost pools, the last stage is to absorb the service cost. We transfer all the service cost into the production departments. And those are the 3 stages or the 4 stages of activity. So the question only required 3. I've added you one more. Part B reads, BICS Limited reapportions the costs incurred in 2 service cost centers, namely material handling and inspection, to the 3 production cost centers of machining, finishing, and assembly. The following are the overhead costs which have been allocated and apportioned to the first cost centers. So we have machining, finishing, assembly, material handling, and inspection. We've been given the amount which is in millions. Then estimates of the benefits received by each cost center are as follows. We have machining, finishing, assembly, material handling, and inspection. So we have the details for material handling and details on inspection for all other departments. They required calculate the charge for overhead to each of the 3 production cost centers, including the amounts reapportioned from the 2 service centers using Roman 1, the continuous allotment, in brackets, repeated distribution method. So we want to begin with the Roman 1. This is part B, Roman 1. Part B of question 3, Roman 1, we are required to apportion overheads using continuous allotment or repeated distribution method. In continuous allotment method, we normally assume that we have service departments and we have production departments. So service departments are providing services to each other as well as to production departments. So when we have such happening, it means that we have to do what we refer to as reciprocation of one service department with the other service department. And therefore, the process normally involves repeated apportionment until we ensure that we have zeros in the service department. And to do that, we'll use a table that will help us to do the apportionment. So we'll have space, then we have basis of apportionment. We'll have the department, machining. We have machining. We have finishing. We have assembly. We have material handling. And then we'll have inspection. So we'll have a table. So the values are in shillings. The values are in shillings. So we'll have these in shillings. So we have a table that is showing the basis of apportionment, machining, finishing, assembly. So in the question we were told that machining, finishing, and assembly are production departments. Material handling and inspection are service departments. When you look at the question paper under estimates of benefits received by each cost center are as follows. Material handling is providing 30% to machining, 30% of its services to machining, 25% of its services to finishing, 35% of its services to assembly, and it is providing 10% of its services to inspection department, which is a service department. Then we have inspection is providing 20% of its services to machining, 30% of its services to finishing, 45% to assembly, 5% to material handling, which is a service department. So we need to identify the allocated and apportioned overheads which are given in the question. We have a note, the following are overhead costs. So we have allocated and apportioned. Apportioned overhead costs. Allocated and apportioned overhead costs. For machining, this is in millions. In millions, shillings in millions. In millions. Sorry. Shillings is in millions. Shillings in millions. It is in shillings in millions. Shillings are in millions. Also show that millions. and then this is also shillings in millions. In millions. So for machining, we have 400. That's 400 million. This is 200 million, 100 million, 100 million, and 50 million. That is the allocated and apportioned overheads. So we need to identify the basis for apportionment, but before we find the basis of apportionment, remember we have two service departments, material handling and inspection. So in continuous allotment method, it doesn't matter which service department you begin with. You can either begin with the material handling or inspection. So let's begin with by apportioning material handling. You simply write apportion material handling. Remember, apportioning is simply referring to division of a value to various departments that used that service. So material handling had 100 million. This is what it means. It simply means the 100 million incurred under material handling was incurred simply because material handling was providing services to machining, finishing, assembly, and inspection. And therefore, we are to transfer 100 million to these other departments that use the service in the ratio provided. I'll use this for our workings. This is our working space. Sorry, workings. Just have workings. And this is working number 1. Basis of apportionment for material handling. So material handling is providing 30%. We have the ratio of 30% to 25% to 35% to 10%. 30 to 25 to 35 to 10. So we are to identify the right ratio that we need to, which we'll use under the basis of apportionment. And for us to find the ratio, we are simply to use the lowest figure that is divisible in all these values. And the lowest figure is 5. So 5 will be divisible in this. So 5 will be into 30, 6 times, to 25, 5 times, to 35, 7 times, and to 10, 2 times. And that will be our basis of apportioning this amount. So we'll have 6 to 5 to 7 to 2. So when we take 6 plus 5 plus 7 plus 2, it will give us a total of 20. So we remember we are apportioning material handling with 100. So to calculate the amount for finishing department, this is working 2, finishing department. This is material handling ratio. Finishing department will be equal to 6 over 20 times 100. 6 over 20 divided, multiplied by 100. And this will give us 30. So we apportion that 30 to machining. We do the same to, sorry, this was machining, not finishing. This was machining. And then to finishing department, we'll simply take 5 over 20 times 100. 5 over 20 times 100 will give us 25. So we'll have 25, and you do the same for the others. Take 7, divide by 20 times 100. It will give us 35 to assembly. And then 2 over 20 multiplied by 100, which will give us 10 to inspection. So we have transferred the whole of this amount, and therefore we make it a negative, but we now add the value in the inspection column, and this will give us 60. Then we apportion. Next is to apportion inspection. We apportion inspection. And what is the ratio for inspection? This is working 3. Inspection ratio. Inspection ratio. So according to the question, we were told that inspection provides 20%. So we have 20 to 30 to 45 to 5. The lowest figure that can be divided in all these is 5. So 5 into 20 is 4, into 30, 6, into 45, 9, and into 5, 1. So we have the ratio of 4 to 6 to 9 to 1. And so to find for machining, remember the amount that we are apportioning is 60. We are taking 4 plus 6 plus 9 to get the total. 4 plus 6 plus 9 plus 1, which will give us 20. And to apportion for machining, we will take 4 divided by 20. We multiply by 60, which will give us 12. Can show that under working number 4, machining. We are simply taking 4 over 20 and we are multiplying by 60, which will give us 12 shillings. 12 shillings. We do the same for finishing. This will be 6 over 20 multiplied by 60, which will give us 18. Then for assembly will be 9 divided by 20 multiplied by 60, which will give us 27. And then to material handling is 1 divided by 20, and then we multiply by 60, which will give us 3. We make this a negative. Why? Because we have transferred the whole of that figure to other departments. So under material handling, we still have 3. Our intention is to ensure that we have zeros in the service department. And therefore, we say we repeat the process. So we repeat to apportion material handling. And what are we apportioning? We are apportioning in the ratio of 6 is to 5 is to 7 is to 2. And what we are apportioning is 3 to ensure that it becomes a 0. So we'll have 6 plus 5 plus 7 plus 2, which is giving us 20. We take 6 divided by 20 times 3. This will give us 0.1, which can be rounded off to 1. Then 5 divided by 20 times 3 will give us 0.75, which is equal to approximate to 1. Then 7 divided by 20 times 3 will give us 1.05, which is 1. And then 2 divided by 20 times 3 will give us a 0. So here we have a 0. And here we have transferred the whole of this. And that simply means our solution has been reached and we simply get the sum. So when you get the total, our service departments have zeros. So this is a 0. And we are now supposed to get the total for the production department. We get the total for production department. So for machining, we have 400 plus 30 plus 12 plus 1, which will give us 443. Then we have 200 for finishing plus 25 plus 18 plus 1, which will give us 244. Then 100 plus 35 plus 27 plus 1 equals 163. And then we'll be done with part 1 of that question. Then part 2 of the question. Part 2 of the question, we are required to use algebraic method. Algebraic method is any method that can help in solving a pair of equations. So a pair of equations here is referring to a simultaneous equation. So in this case, we'll use simultaneous equations method or simultaneous equations method where we will have to solve using elimination method. So it is normally an alternative method to continuous allotment, and therefore it should yield the same results. And how do we do this? So let's do part 2. This is question number 3 part B, Roman 2. Roman 2. We are using the algebraic method. Algebraic method. This was continuous allotment method. Continuous allotment method, and this is algebraic. So we are required to formulate 2 equations. Why 2 equations? We have 2 service departments. So when we have 2 service departments, we are required to formulate 2 equations. And each equation should state the original or the allocated or apportioned overhead cost and the proportion of the other department that is apportioned or to be apportioned to it. So when you look at this paper, we have material handling, which is providing 10% of its services to another service department, which in this case is inspection. And inspection is providing 5% of its services to material handling, which is also another service department. So we are to formulate 2 equations as follows. Let material handling total cost be represented by X. So we are representing material handling by X, and then we let inspection total cost be represented by letter Y. So X is representing material handling and inspection is represented by Y. So we want to formulate the equation for material handling, which is represented by X. So we'll say material handling, or X, equals the original and the allocated amount that is to be apportioned or allocated to material handling. From this table, you can see that it is 100 million. So the equation is formulated into 2 parts. One, it must have the total, the original total or the allocated, plus the proportion of the other service department. Proportion of the other service department. When you look at that question, we have machining, finishing, assembly, material handling, and inspection. Material handling is being provided by inspection with 10%. Material handling is providing services 30% of its services to machining, 25% of its services to finishing, 35% to assembly, and 10% to inspection. And then inspection is providing 20% of its services to machining, 30% to finishing, 45% to assembly, and material 5% to. So the other proportion, or the proportion of the other service department, so the other service department here is inspection, and inspection is providing 5% of its services to material handling. So we'll have the original amount plus the proportion of the other. So the other service department inspection, which is plus 0.05 Y. And then we also formulate for inspection represented by Y will be equal to the allocated amount to it is 50. In this case, not 60, it is 50. So we take 50 plus the proportion of the other service. So the other service department is material, and material handling was providing 10% of its services too. So we take 0.1 x, 0.1 x. Then we rearrange the equation into simultaneous format. So to rearrange this, we'll have x equals, we'll have x minus, we are taking this, the other side, 0.05 y, which will equal to 100. And this will become our equation number 1. We do the same for the second equation. We are bringing 0.1 the other side, so we'll have negative 0.1 x plus y equals 50. And this becomes our second equation, which we now solve using simultaneous equations, using elimination method. So to solve this, we want to eliminate values either at x or y. Eliminating values at x, we simply multiply negative 0.1 and the second line by 1. So I've cross multiply. Take negative 0.1, multiply by the first line, take 1, multiply by the second line, and then we'll be able to solve. So negative 0.1 times x is equal to negative 0.1x. A negative times a negative will be a positive. So we have 0.1 times 0.05, we'll have 0.005 y equals 100 times negative 0.1 will be equal to negative 10. We multiply 1 by the other line, so this will remain to be negative 0.1x plus y equals 50. And then we subtract. So we take negative 0.1 minus minus. So negative 0.1 minus minus will become, is the same as negative 0.1 plus 0.1, which will give us a 0. And then we have 0.005 minus 1, which will give us negative 0.995y equals negative 10 minus 50 will give us negative 60. Then we find y. So y will be equal to 0, negative 0.995y. We divide both sides by negative 0.995, which will be equal to negative 60 over negative 0.995. Solving that, y will be equal to y will be equal to 60.3. Then we substitute to get the value of x. We can use the first line. So we have x minus 0.05y equals 100. We already have y, the value of y, so this will be x minus 0.05, 0.05, not 0.5, yes, 0.05 into bracket 60.3 equals 100. So this will be equal to x minus 3.015 0.05 times 60.3. 3.015 equals 100. So selecting the like times, x will be equal to 100 plus 3.015. So x is just equal to 103. We round it off to a whole number, 103. So first step, we have formulated the equations. The second step is now to do the apportionment. And for us to do the apportionment, we'll use the table as follows. We'll use the table. So we will have space, then we have basis of apportionment, then we have machining, we have finishing, we have assembly, we have material handling, and then we'll have inspection, and each is in millions. So we'll have that table. So we had it in millions of shillings. So it is all in millions of shillings. So we are beginning with allocated and apportioned. And apportioned overhead costs. So the allocated and apportioned overhead costs for production departments will remain the same. So for machining was 400, for finishing was 200, for assembly 100. But now when it comes to material handling, we are not using the original amounts of 150, but we are now using the results of the simultaneous equations. So y represented inspection and x represented material handling. So for material handling, the amount will be 103 and inspection will be inspection was 60.3. It will be 60.3. So we begin by apportioning either of the service department. So we say apportion material handling. And the ratio will not be the same as in this case. we are to use the percentages the way they are. So what are the percentages? For material handling to machining was, we'll use 30%, 25%, 35%, 30%, 25%, and 35%. We are apportioning only to production departments. So we are to apportion 103 using these percentages. So we calculate for finishing. For finishing, we'll have, can have the working part, workings. For machining, we are simply taking 30% times 103. So 30% times 103, we get 30.9. And 30.9 is what is to be apportioned to machining. Then finishing will be equal to 25% multiplied by 103, which equals 25.75. So we'll apportion 25.75. And then the last one is assembly, which will be 35% multiplied by 103, and this equals 36.05, which is just equal to 36. We make this a negative, but we don't want, I'll show the reason why I'm not making it a negative now. When you take 30.9 plus 25.75 plus 36, the total you get is 92.65, which we make a negative. And then we come here and apportion inspection. We now apportion inspection. We apportion inspection, and the percentages for inspection were 20%, 30%, and 45%. So we are apportioning 60.3%. Remember, once you've calculated that simultaneous equation, we are not apportioning any amount to the service department. So we are only apportioning to production departments, and therefore don't include any service department. So we'll have 20%. This is inspection. 20%. This is inspection. This was material handling. This was material handling. And inspection will be 20% multiplied by 60.3, which will be equal to 12.06. We apportion 12.06 to machining, then get 30% of 60.3 and apportion it to finishing, which is 18.009, and then 45% multiplied by 60.3, which will give us 27.14. Then the total of the all three, 12.06 plus 18.09 plus 27.14 will give us 57.29, which we subtract, but now we show that the balances are zeros. The balances are zeros. We say that the method is not very accurate, and because of the inaccuracy of the method, that's why we are having balances in the service departments, but they ought to be zero. So once you've done that, simply indicate that we have zeros in the service departments. Then we get the sum for the production departments. Get the sum for the production departments. So for machining, we have 400 plus 30.9 plus 12.06, which will be 442.9, which is the same as 443. And then we have 200 plus 25.75 plus 18.09, which will give us 244. Then we have 100 plus 36 plus 27.14, and this is 163. So I say that this method is an alternative method to continuous allotment, and therefore it should yield the same results. So this was question number 2. You can also use other methods. Under the same part 2, we may also be required to use a reciprocal method and then sometimes direct method. So you need to know how to calculate or to apportion overheads using direct method or direct allotment method and reciprocal method. And this marks the end of our question number 3. Bye-bye and welcome to our next session, where we'll be dealing with the question number 4 of the same paper.
Let us now move to answer part C of question 1, May 2019. It says, discuss the procedures involved in applying forensic auditing in fraud investigations. 8 marks. The procedures involved in applying forensic auditing in fraud investigations. Here again is another straightforward question. Procedures involved in applying forensic auditing and fraud investigations. We are still on May 20. This is May 2019. Question 1C. It says, discuss procedures involved. These are procedures involved in applying forensic auditing in fraud investigations. Now, what is forensic auditing? Forensic auditing, candidates, is the application of accounting records in the collection of evidence for the purpose of securing prosecution in a judicial forum. Let me write that down. Forensic auditing. Forensic auditing is the application of accounting methods. The application of accounting methods to the tracking and collection of evidence, usually for investigation and prosecution of criminal acts like embezzlement or fraud. All right, usually for investigation and prosecution of criminal acts such as embezzlement of funds, embezzlement or fraud. Embezzlement or fraud. So forensic auditing may also be referred to as forensic accounting. It is the application of accounting methods to the tracking and collection of evidence, and this evidence may be used for investigative purposes or for prosecution of criminal acts like fraud. In this question, we are to discuss the procedures involved in fraud investigations. So we are going to outline the procedures. And candidates, it's important to note that forensic auditing is the application of the accounting methods. So if you are preparing to sit for the advanced auditing paper, you are conversant with these methods. This is what you've been learning since you began the CPA course. We've been learning how to make records, to record transactions. We've learned how to prepare books of accounts, to prepare the what we call business papers, the source documents, how to transfer information from the books of accounts to the trial balance, the financial statements, and so on. We understand the accounting process, all right? The accounting process, you are well conversant with the accounting process or accounting generally. So here, how do you conduct fraud investigations? Step number one. Number one, I will just list the procedures. Number one is develop. First step, develop the profile of the company under investigation, of the company or the firm under investigation. Now, a profile is simply a short description of the company, including the company personnel. So you come up with a brief description about the company. That is the first step. Company profile, including the personnel, the company's personnel. Step number two is to identify weaknesses. Identify weaknesses in the internal control procedures. Identify weaknesses in the internal control procedures. This internal control system we covered in detail in the previous paper in auditing, how to tell that a company's internal control system is weak. There are signs of a weak internal control system which you can capture as a forensic accountant. So you can identify the weaknesses, list down the weaknesses. For example, you may find a company that does not prepare control accounts, for example, right? Because preparation of control account in itself is a control measure, an internal control measure. A company that does not prepare control accounts, then that company's internal control system may be weak. Another control could be preparation of the bank statements. if you observe that a company does not prepare bank reconciliations, okay, does not prepare bank reconciliations, then that is a sign of a weak internal control system for cash. So there are many signs that you may capture as an investigator in the process of identifying weaknesses. So identify all the weaknesses in the internal control system. That is step number 2. Step number 3 is to perform trend analysis. Perform trend analysis and analytical procedures. Analytical procedures to identify, the purpose is to identify significant transactions and significant variations. To identify significant transactions and variations. For example, if you do ratios, you conduct ratios, accounting ratios on the balances provided, so that you can see abnormal variations or unusual variations or significant variations. For example, the liquidity ratios for several years, you can tell if there are variations that are not normal. All right, we know the ideal liquidity ratios for a given industry. So you compare the company's ratios vis-a-vis that of the industry to identify significant transactions or variations in the trend analysis. And this is through preparation of analytical procedures. Number 4, identify changes in patterns. Changes in patterns of items like purchases or sales. Identify patterns. The changes in patterns. Identify changes in patterns. The changes in patterns may be as a result of fraudulent activity. So you need to observe and record down the changes in patterns of purchases or sales. Number 5, identify significant variations. Identify significant variations of, here we talked of purchases, we have sales, we can say variations of raw materials, particularly where consumption seems excessive. All right, identify significant variations of raw materials, particularly where consumption seems excessive. Excessive consumption. So these are 5 procedures. Number 1, develop the profile of the company under investigation. I've said company profile would simply be a description of the company, what the company does, the mission of the company, and so on. The vision of the company, objectives of the company, the industry in which the company operates, any key information regarding the company. Then you also come up with a profile of company's personnel. You can draw an organizational structure that will help you understand the management structure of the company. That is step number 1. Step number 2, identify weaknesses in the internal control system. I've given examples. Step number 3, perform trend analysis. Number 4, identify changes in patterns of purchases and sales. Identify significant variations of raw material, especially where consumption seems to be excessive. Number 6, identify unusual accounts and unusual account balances. Like, for example, a situation where you have credit balance on closing debtors, like closing credit balance on accounts receivables. Normally, the debtors account or the account receivables has to have a debit balance. Debtors are assets, and assets always have a debit balance, closing debit balance. But if you have a situation where the debtors closing balance is a credit balance, then that is unusual. The same would also happen for the accounts payables balances. If you have an account payable balance being a debit balance, then that is unusual account. So identify unusual accounts. We know liabilities accounts must have a credit balance at the end of the accounting period. That is liabilities plus capitals. Then the assets must have debit balances and so on. So if you have a situation where some accounts have unusual account balances, then you need to identify such. This is number 6. Another procedure that can be performed, this is 6. Number 7 is review accounting records. Review accounting records for unusual transactions. Not executed at normal commercial rates. If there are amounts within the accounting records that have been arrived at by using commercial rates that are not normal, then you need to review those records. For example, if you have the rates provided by the suppliers, okay, because items are bought from suppliers. If you identify that there are rates that have been applied apart from the rates provided by the suppliers, then you need to review those accounting records. Then number 8, the 8th procedure is review source documents. Or accounting documents. Review source documentation or documents like invoices for discrepancies and discrepancies and in inconsistencies. Check the source documents like invoices. Are there discrepancies? Are there inconsistencies? There could be discrepancies of many kinds or inconsistencies. So check if there are any inconsistencies or discrepancies within the source documents like invoices, like the delivery notes, and so on. Then number nine, once these have been identified, these discrepancies and consistencies, let me write here 9, once identified, trace the individual. Trace the individual responsible for the fraudulent transactions. Okay, it's not easy. It's not difficult to identify the individuals responsible for such fraudulent transactions. Remember, we've been identifying discrepancies, we've been identifying mistakes, we've been identifying weaknesses within the control system, within the source documents, within the account balances. So once these have been identified, procedure number 9, identify the individual responsible for the fraudulent transactions. That is the next procedure, obvious procedure. Next procedure is to identify the individual. Remember, forensic auditing, we defined it as the process of tracing, of tracking, of checking the accounting records using accounting techniques to identify or to gather evidence, all right, forensic evidence, for the purposes of securing an investigation or prosecution in a judicial forum. So we have an individual here, assuming this individual has been traced. Trace the individual. Trace the individual responsible for fraudulent transactions. Number 10, obtain information. Obtain information regarding all the individuals. It can be an individual or individuals, regarding all the individuals involved. Look, dig deep. If it is an individual in the accounts department, get information regarding that individual. If it's a network of individuals who are in collusion, then get in all information regarding these individuals within that network. So that is very important procedure. Procedure number 11, inspect all transactions. Inspect all transactions conducted or performed. Transaction, let me say transaction of similar nature, all transactions of similar nature conducted by the individual or individuals. After obtaining information regarding all the individuals, you may find some information. Then that information should be inspected and identify if there are similar transactions of similar nature conducted by the individual or the individuals. Then number 12, perform further analytical procedures. Perform further analytical procedures. Analytical procedures targeting these other areas to identify additional discrepancies. That is procedure number 12. Procedure number 13, quantify the loss, because this is fraud. If the company has lost money as a result of these fraudulent activities, then put a figure to the loss. Quantify the loss. State how much is involved in these fraudulent activities. Then lastly, number 14, you can, as a last procedure, interview the suspected individuals, and the purpose is to obtain a confession. That is, interview the suspected individual or individuals to obtain a testimony or a confession. Let me say, to obtain a confession. So that is the procedure that can be followed. Procedures can be followed or involved in applying forensic auditing in investigations, in fraud investigations. So this would earn you how many marks? This can earn a candidate 8 marks. These are 8 marks. Simply identifying or listing down the procedures. And you can see these procedures flow in a certain logical sequence. First, we said, develop the profile of a company under investigation. 2, identify weaknesses in the internal control system. 3, perform trend analysis and analytical procedures. 4, identify changes in patterns of purchases or sales. 5, identify significant variations of raw materials, particularly where consumption seems excess. 6, identify unusual accounts and account balances like closing credit balance on accounts receivables, or we said the closing debit balance on accounts payables. That is an unusual account. Then 7, I review accounting records for unusual transactions not executed at normal commercial rates. 8, and on this point you've heard of cases before where a pen has been bought at 500 shillings. That is a pen which we know goes for 15 shillings. In some quarters it has been bought at 500 shillings. So those are rates that are not normal. So when you are reviewing accounting records and you come across unusual rates, commercial rates, then you will have to go back and review such records. I gave an example of rates provided by suppliers, where suppliers have provided rates and those rates have not been used in the company's accounting records. Then you check such areas. There could be room for fraudulent activities. Then 8, we said review source documents like invoices for discrepancies and inconsistencies. These candidates we covered in basic accounting, where we saw there are errors that can be deliberate, others may not be deliberate. Okay, we check for such discrepancies and errors in source documents. Number 9, once identified, trace the individual responsible for the fraudulent transactions. At this point now, after identifying the discrepancies, the areas that the fraud could have been committed, then you need to identify those individuals or the individual that is behind the fraudulent transactions. After identifying the individual who may also be working in collusion with other employees, then obtain information regarding all the individuals involved. Obtain their information. Number 11, inspect all transactions of similar nature. All right? Inspect all transactions of similar nature conducted by the individuals. Then perform further analytical procedures. These procedures, remember, we had conducted in our previous step, but having obtained information, new information, all right, after this inspection, then perform further analytical procedures targeting these other areas to identify additional discrepancies or inconsistencies. Then lastly, quantify the loss. Because this is fraud, the company may have incurred losses occasioned by these fraudulent activities. Put a figure to the loss. Then finally, interview the suspected individuals to obtain confession. So that is how the candidates were required to answer question 1C of May 2019. So candidates, that will mark the end of today's lesson, where we began to revise the paper that was tested in May 2019. In our first lesson, we have covered lesson number 1. In our next lesson, we are going to tackle question number 2. So before you attempt the next lesson, please try to answer the question on your own. When you come to the next class, we will compare notes here on the board. Bye-bye.
Hello learner, welcome to Manifested eLearning platform. My name is FAM Ngwiri, and today we are discussing about the financial modeling and data analytics paper which came out in March 2023 as a pilot paper, question 23. It reads as follows: Company XYZ issued a bond to finance its expansion plans. The bond has a face value of 1,000, a coupon rate of 5% per annum, and a maturity date of 31st December 2028. The bond pays a semi-annual interest payments. The bond is trading at 950 as at 31st December 2022. The time to maturity as a result is 6 years. Using Excel, build a financial model that includes the following statistical and analytical aspects. A. Calculate the bond's yield to maturity using Excel. B. Calculate the bond's modified duration using Excel's duration function. C. Using Excel's data table feature, plot a graph that shows the bond's price sensitivity to changes in interest rates, assuming the range of interest rate changes from -2% to 2%. Plot a line chart that shows the bond price as a function of the interest rate. The x-axis should show the range of interest rates and y-axis should show the bond price. Save the chart on the worksheet. So we'll move over towards the right of your screen right here where the solution. and we can be able to answer part A right here. So A. We're told to calculate the bond's yield to maturity using Excel. So what we're going to do is that we're going to come over here and first of all indicate the values that we actually need. We need the face value there. Then we are going to also be required to put in the bond price. We'll also be required to get the coupon rate there. Moving on, we need then to also get the annual coupon. Then we move ahead and indicate the current date. And then we put in the maturity date. We also need the years to maturity. And finally, we'll need now to compute the yield to maturity. That. So we double click there, then we put it in form of a table like so. Come right here. We can click all borders, and then the outside border we can be able to put a thick outside border like so. So we can then now put in the values as required over here. This is where we want our answer and what we've been requested to compute the yield to maturity using Excel. So we come over here and perhaps put maybe a very light color that shows that that is going to be our answer. So the face value, in this case, we're going to put 1,000. That. The bond price, we're told that the bond is trading at 950. So 950. That. And then we're saying that the coupon rate, a coupon rate of 5% per annum, so 5% and per annum. So just put the coupon rate, so this is annual, 5, so you can just put it as percentage, and right over here, we just click on percent, right here, 5, so that's 5% per annum. So the annual coupon is just going to be, we're just going to multiply that value, which is the coupon rate, and then we multiply against the par value. Against the par value or the face value right there. So that's the annual coupon. So then we slot in the current date. From the question, we can see that we have been given the maturity date as at 31st December 2028. The bond pays semi-annual interest payments like that. The bond is trading at 950 as at December 31st, 2022. So the current date is 31st December 2022. So 31st December 2022. That. So that's the date there. The maturity date is given to us over here as 31st December 2028. December 2028. That. And so once we have the maturity date, we then need to see the years to maturity. How many years are remaining towards maturity? So we pick the maturity date over here. You can see it's 6 years. It's actually given to us here in the question. So it's 2022 to 2028. That. So 6 years like that. For us to be able to compute, then we can just move towards the right over here, the screen. This. For us to compute the yield to maturity, what we need to know, the yield to maturity, TM, is given as, we will first of all need to get the coupon rate,
C, and then we add now this component that is over here like that. We're going to get the face value, then we subtract the present value or the current price, so minus PV right there, and then this part that is in brackets, it should be divided against N, which represents the years to maturity, N, like that. And this entire part right here, like that, should be divided. Use this feature over here, just underline like that. Or you can just use the borders, We divide that against face value plus present value and this is being divided by 2 over 2. That's how we calculate the yield to maturity. So just come over here and margin center over here like this, and then we put it towards the center there. So that's how we compute the yield to maturity. So let's put it right in this box over here. So we need the coupon rate over here plus the coupon rate there, and then we add the face value. So we need to first of all open a brackets over here like this, plus then we open a bracket right over here like this again, because this component will be divided, this component over here will be divided by N over here. So the face value that we subtract the present value, which is the bond price over there like that, and then we are dividing that by N like that. So this one we divide by over the number of years, which you're seeing N represents the number of years to maturity like that. So you're seeing it's going to be this part over here like this. So just put it like so. Open the brackets over here, like that, and then that part, so that part is being divided by that part like that. So this component over here, this minus that, we're dividing it by that value over here. So we close the bracket right over here again, and then we divide that numerator against face value. You can just over here, just following this formula here. So we open the brackets, face value plus present value, which is what we're saying is the current price, plus the current price over 2. So just to confirm if everything is okay, so we talk about 06 over here. It's supposed to be 07. Yes, it's supposed to be 07. We talk about the annual coupon. See, the C represents the coupon, annual coupon. So we put 07 there. 07. That, yes. Then plus 04 minus 05. So 04 minus 05, just going by this, divided by N. So we divide by 010. 010 is this value over here. I think is the number of years. And then we divide all of that by 04, which is in the face value, yes, plus present value over 2. So we just enter. So that's what we have as our yield to maturity. Moving on, we can then move on to part B. Calculate the bond's modified duration using Excel's duration formula, or function rather. So here we move on to the right. Come here, B. Talking about the modified duration. So you can just talk about modified duration. modified duration. How do we compute the modified duration using Excel? We just come right here to the formula bar right here. We click on that and we say duration. We click on duration. We just type in duration and we enter. So this is duration, and the narration of this duration is mentioned down here. Returns the annual duration of a security with a period with periodic interest payments. We do not want that. We want M duration. Returns the Macaulay modified duration for a security with an assumed par value of 100, and this is what we want, M duration. So we say okay. So the settlement represents today's date or the current date, and we click it there. Then we click right back over here. What is the maturity? It's the maturity date right there. The coupon represents the coupon rate, not the annual coupon rate. There, click that. And then the yield. The yield is what we've computed right over here to the yield to maturity. What are we told in terms of the frequency of payment? We're told in terms of the frequency and payment is that it is semi-annual. Moving towards our life, the bond pays semi-annual interest payments. So we put over here 2, like that. If it is 1, there are 2 payments in a year. So if it is 1 payment, then we put 1 payment like that. But now in this case, which there are 2 payments in a year, we put that component here. The basis it just represents the day count basis and how you're going to compute the modified duration on a daily basis and so on and so forth. So just leave it blank like that. You say okay. So this is the modified duration, and of course it is in terms of years. For a one-time parallel change in the yields will cause the duration to change by 5.08 years. That's the interpretation. We can move on to the left side here and see what we're being asked. Using Excel's data table feature, plot a graph that shows the bond price sensitivity to changes in interest rates, assuming the range of interest rate changes from -2 to 2%. So that's what we're going to do right over here. We will need then, first of all, to determine the bond price. The bond price we already given, and that's why it doesn't have a formula over here. How else do we compute the bond price? The bond price is representative based on the face value here. So we can put a formula over here and say that we can get the 950 in a different way. So we say we put plus 1000, or we put plus this value over here like that, and then we are subtracting the interest payment or the coupon payment. So we open the brackets, we take that value times coupon rate, which is annual. That, we close the brackets, and we get the 950 like that. To be able to use the Excel's data table feature, we will need to have the range of interest rates over here, rates, and we are told from the question right here, it's from -2 all the way to +2. So we can use intervals of maybe say perhaps 0.5. So we have -2. Of course, this is in percentages, so you can just go down right like that up to any place right down there, and then we highlight and we click on this. So the interest rates will be in percentages. So we'll have -2%. Then we'll have -1.5. I'm just using 0.5 as just to indicate the a range that is maybe reasonable. Then here we have go all the way like that. So it's going to be like that. So we're saying a negative 1.5, so we have negative 1%, and then we have negative 0.5. It's just 0.5, 0.5. Then here we have 0. Then we have 0.5, 1, 1.5, 2. That. So these are the interest rates that are changing. Center them. It's like so. And we need then to see the impact on the price of the bonds. So here we will now go to the Excel's data table feature. But before we do that, we need to just link it with this bond price right over here. Why are we linking it? When we move over to data tab right here, and we can be able to now go to what if analysis, and we'll be able to see data table. There are two types of data tables. There is a one variable data table, and there are two variable data table. In this case, because we only want to see the effect of changes of interest rates on the price, we are only going to use a one variable data table. So we click on the data table feature over here, and we try and see what is increasing moving towards the right row, moving towards the right. There really is nothing that is moving towards the right. But what is increasing moving towards in a column feature over here? We are saying that we want to input this component that is right here, which you're saying is the bond price here. Let's see what is going to happen. But before we do that, I want we first of all highlight this. We should have first of all highlighted that. Then we come to what if analysis, data table, row input is something that's increasing towards the row. Column input, we want to see the impact on the prices. So we put the price over here of 950. We say okay. So in this case, the price comes over. You need to be very careful, guys, when using the Excel feature data table. So let's undo that, and we put over here, now we delete that, we put the 950, so plus that value. I want to show you the impact of the data tables of how you're supposed to run it. So once you put the 950 there, pick the value from the information right over here, or the formula right over here, the bond price. So what we do is that for us to run this on a data table feature, we need to then come to what if analysis, data table. This is a one variable data table, meaning that we are only going to put in the column values here. Why not the row value? The row value is not increasing in any form or changing in any form moving towards the right. It's the column. Which column is changing? Interest rates right here. So we come to column, and then we move back up right over here and go to coupon rate, that is interest rate. And then we say, okay. You see the magic that happens now? We can see the interest rates over here are increasing, and at negative 2%, the bond price will be 1020. If it's negative 1.5, the bond price will be 1015, and so on and so forth like that. For us to be able to prove, we can then rerun this and put over here 5%, which is the current annual coupon rate over here, 5%. So let's see what price it will give us. The price should be 950, At 5%, the bond price should be 950. So let's see. We put over here 5%, like that, and then we just do away with this. For example, come back home, format painter, come there. So if we were to run it again, we highlight there, this has to be arranged like so, where the price is slightly above the interest rate. So we highlight that part like that. We come to data, we come to what if analysis, data table. The column is the one that is changing, interest rate is what is changing here. So you're saying the interest rate is the same as the coupon rate here. So we say, okay. You can see clearly that at this point here, we have the prices, at interest rate 5%, the price of the bond is 950. And that is exactly what we have here. The bond price is 950 at coupon rate at 5%. Now we can then move on to part D. Plot a line chart that shows the bond price as a function of interest rate. The x-axis should show the range of interest rates. And the y-axis should show the bond prices there. So let's plot it. So what we need to do then, ladies and gentlemen, is that we highlight this information right over here. We move on to the insert tab over here, and then we click on the scatter graph over here. So once you click on the scatter graph over here like this, this is the graph you should be able to have over here. You rename it to bond prices, like that. And indicatively, you can see that the interest rates have been indicated right over here. But you can be able to now add the chart titles. So let's include the chart titles to make it complete. Bond prices, and here we're talking about the interest rates. And there's that relationship, inverse relationship between the prices and interest rates. So we have now answered part D. Plot a line chart that shows the bond prices as a function of interest rates. The x-axis should show the range of interest rates. The y-axis should show the bond price. Save the chart on our worksheet, and you can see the interest rates, and we had been taking our data from over here up to this point. We're not interested in this 5% right over here because we need to be consistent in our data. So the data right here begins from -2, which is over here. The bond price you can see is M120 all the way through to M2 here, where we have the bond price as 980 right there. So this brings us, ladies and gentlemen, to the end of the question 23. We hope you have enjoyed the class. Thank you and God bless you.
Hello, I greet you all from wherever you are, and I'm glad to welcome you to the revision of auditing and assurance paper, September 2021. In our last session, we answered question 1. Today, we will proceed to suggest solutions for question number 2. I'll first answer question 2A, which says, distinguish between reasonable assurance engagement and limited assurance engagement. 4 marks. Distinguish between reasonable assurance engagement and limited assurance engagement. Now, candidates, what is an assurance engagement? An assurance engagement is defined as an engagement in which a practitioner aims to obtain sufficient appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the subject matter information. All right? That's the meaning of assurance engagement. And just to help you understand, candidates, what's the meaning of assurance in this context? Now, assurance, candidates, is a measure of the level of certainty that the auditor has obtained at the completion of the audit. It is a measure of the level of certainty or the level of confidence that the auditor has obtained at the completion of an audit. The question is, distinguish between reasonable assurance engagement and limited assurance engagement. That is the question. Distinguish. This is question 2. Question 2A. Distinguish. Distinguish between reasonable assurance engagement and limited assurance engagement and reasonable. Candidates, distinctions sometimes can be made on the basis of the definition of terms. So by defining reasonable assurance engagement and defining limited assurance engagement, that can earn you a mark. So what's an assurance, reasonable assurance engagement? Candidates, a reasonable assurance engagement is defined as an engagement in which the practitioner reduces engagement risk to an acceptable low level. Let me have the distinctions in form of a table. Let me have them in form of a table. So that here we have reasonable assurance engagement and limited assurance engagement. I've just defined reasonable assurance engagement as an assurance engagement in which the practitioner reduces engagement risk to an acceptable level. The practitioner here is an auditor. So the first distinction is that the practitioner reduces the assurance engagement risk to an acceptable low level, to an acceptable low level in the circumstances of the engagement as the basis for a practitioner's conclusion. A limited assurance engagement, on the other hand, is a reduction in assurance engagement risks to a level that is acceptable in the circumstances of the engagement, but where that risk is greater than that for an reasonable assurance engagement. So for limited, the engagement, the audit, or let me say the assurance engagement risk is higher compared to the reasonable assurance engagement. The assurance engagement risk for a limited assurance engagement, the engagement risk is higher or greater than for reasonable assurance engagement. Why? Because the basis, it forms the basis for a negative form of expression of the practitioner's conclusion. That is the first distinction. That one is on the basis of the assurance engagement risk. In the first instance, it is low. In the second instance, is high. And we'll be seeing why that is the case by just looking at the second distinction. The second distinction is in relation to the level of testing. The level of testing. In the reasonable assurance engagement, analytical procedures are performed to identify material misstatements. Analytical procedures are designed and performed in such a way that the tests or the procedures can identify material misstatements. Material misstatements. Now, for the limited assurance engagement, analytical procedures may be designed, but in this case, it's not for the purpose of identifying material misstatements, but to support expectations regarding the trends, the relationships, and ratios, and not to identify material misstatements. So here, analytical procedures are designed and performed to support expectations, regarding the direction of trends, regarding direction of trends, etc., and so on. The analytical procedures, which are just testing. Testing is designed, procedures are designed not to identify material misstatements, but to support expectations regarding direction of trends and also relationships and ratios, rather than to identify misstatements with the level of precision expected in a reasonable assurance engagement. Here, the level of precision is higher because of the level of testing. Many documents, many tests are carried out when carrying out reasonable assurance engagement compared to limited assurance engagement. And that's why the risk is higher in limited assurance engagement as compared to the reasonable assurance engagement. That is the second distinction. The third distinction, number 3, gives a positively worded assurance opinion or report. Reasonable assurance engagement gives a positively worded assurance opinion. For example, it can say that it can state that having examined the financial statements of company A and ABC Limited, it is in our opinion that the statements portray a true or fair view, or it does not portray a true or fair view. That's a positively worded assurance. But for limited assurance engagement, it gives a negatively worded assurance opinion. Gives a negatively worded assurance opinion. It gives a negatively worded assurance opinion, for example, that nothing has come to our attention, that the financial statements have not been prepared according to the framework. That is a negatively worded opinion. That nothing has come to our attention, that the financial statements have not been prepared according to the framework. But this one, the opinion is positive. It states that, for example, that having examined the financial statements of ABC Limited, it is our opinion that the statements do not portray a true or fair view. That's a positive. It can be a positive in that sense. But for the limited assurance engagement, the opinion is negatively worded. That's why it gives a low level of assurance. It gives a low level of assurance. It gives a low, that's another distinction, low level of assurance. In a limited assurance engagement, as the name suggests, it gives a low level of assurance, and the reasonable assurance engagement gives a higher level of assurance. Reasonable assurance engagement gives a higher level of assurance as compared to limited assurance engagement. It gives a higher level of assurance that audited information is free from material misstatements, or that audited information is not free from material misstatements. So these are the distinctions. The examiner was not specific as to how many distinctions to give. If that is the case in an exam, if you have points, make sure you give as many points as you can, because here, be guided by the marks. Be guided by the marks. In my case, I assume that this would earn half a mark, 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 half a mark. So these are 4 marks. 4 marks. So that is how to earn 4 marks. Then question 2B, I'm going to answer question 2B. International Standard on Auditing, ISA 705, modifications to the opinion in the Independent Auditor's Report sets out the different types of modified opinions required. With reference to the above statement, discuss 3 ways in which an auditor's opinion may be modified. 6 marks. You can see here, candidates, the examiner was clear on the points. It says 3 ways, 3 ways, 3 ways, all right, in which an auditor's opinion may be modified. This is part B. Ways in which an auditor's opinion may be modified. This question tested the candidate's knowledge on ISA 705, which is in relation to modifications to the opinion in the independent auditor's report. And candidates ISA 705 establishes 3 types of modified opinions. Number 1 is the qualified opinion. Number 2, adverse opinion. Number 3, disclaimer of opinion. There are 3 types of modified opinions. Number 1 is the qualified opinion. Qualified opinion. Now, the first one is qualified opinion. The second one I said is adverse opinion, and the third one is disclaimer of opinion. So let's first look at the qualified opinion. Candidates, under the qualified opinion, the auditor expresses a qualified opinion when he or she, having obtained sufficient appropriate evidence, concludes that misstatements, either individually or in the aggregate, are material but not pervasive to the financial statements. Qualified opinion, I repeat, is where the auditor, having obtained sufficient appropriate evidence, concludes that misstatements are material, where he concludes that misstatements are material. Misstatements are material either individually or in aggregate, but not pervasive. But not pervasive to the financial statements. But not pervasive to the financial statements. Or this is 1, or 2, that or number 2, that the auditor is unable to obtain sufficient appropriate audit evidence. Not able to obtain sufficient appropriate audit evidence, where the auditor is not able to obtain sufficient appropriate audit evidence on which to base his opinion, but the auditor concludes that the possible effects on the financial statements of undetected misstatements, if any, could be material but not pervasive. So a qualified opinion is issued in 2 circumstances. Number 1, where the misstatements are material but not pervasive to the financial statements, or where the auditor is not able to obtain sufficient appropriate evidence upon which to base his or her opinion, but the auditor concludes that the possible effects on the financial statements could be material but not pervasive to the financial statements. That is a qualified opinion, which is a modified opinion. The second modification is adverse opinion. Adverse opinion. Adverse opinion. When is an adverse opinion issued or given? Now, this is where the auditor you can say, expresses an adverse opinion when he or she, having obtained sufficient appropriate audit evidence concludes that misstatements, either individually or in aggregate, are both material and pervasive to the financial statements. So an audit opinion is issued where the misstatement is both material and pervasive to the financial statements. And this can either be individually, material individually, or can be in aggregate. The third modification is disclaimer of opinion. Disclaimer of opinion. Disclaimer of opinion is another modification. Now, candidates, the auditor, we can say, shall disclaim an opinion when he is unable to obtain sufficient appropriate audit evidence on which to base his or her opinion, and that the auditor concludes the possible effects on the financial statements of the undetected misstatements, if any, could be both material and pervasive. Could be both material and pervasive. So in that case, the auditor disclaims his or her opinion. We can say he does that in extremely rare circumstances involving multiple uncertainties. Where the auditor is faced with multiple uncertainties, that is when we can say he can disclaim his or her opinion. And the auditor may conclude that notwithstanding having obtained sufficient appropriate audit evidence regarding each of the individual uncertainties, it is not possible to form an opinion on the financial statements due to the potential interaction of the uncertainties and their possible cumulative effect on the financial statements. So a disclaimer of opinion, in long and short of it, is issued where the auditor is not in a position to form an opinion on the financial statements. It is issued where the auditor is unable to form an opinion on the financial statements. Where the auditor is unable to form an opinion on the financial statements, the reason could be limitation of scope. It can be uncertainties where he does not have sufficient evidence upon which to base his or her opinion. Then he can issue a disclaimer of opinion where he is not in a position to give an opinion because of various uncertainties. Then the auditor shall disclaim his or her opinion. All right? Where it is not possible to form an opinion on the financial statements due to the potential interaction of uncertainties and their possible cumulative effects on the financial statements. So these are three modifications. That is part B. With reference to the above standard, discuss 3 ways in which an auditor's opinion may be modified. These are the 3 ways: qualified, opinion, and we've stated two circumstances here, 1, 2. Then there is the adverse opinion, Then there is disclaimer of opinion. These are 6 marks. 6 marks. Now moving on to part C, which says define the term going concern as per International Standard on Auditing ISA 530. C Roman 1, C Roman 1, C Roman 1, define going concern. Define going concern. Now, candidates, under these basis of accounting, the financial statements are prepared. The financial statements are prepared on assumption that the business will continue. The business will continue for a foreseeable future. That is the going concern concept. Under the going concern basis of accounting, candidates, the financial statements are prepared on assumption that the entity is a going concern and will continue its operations for the foreseeable future, and will continue its operations for the foreseeable future, will continue its operations, will continue its operations, will continue its operations for a foreseeable future. And candidates, going concern assumes that an entity, in other words, will continue in business for the foreseeable future with either the intention nor the necessity of liquidations or ceasing trading or seeking protection from creditors. And therefore, assets and liabilities are usually recorded on the basis that the entity will be able to realize its assets and discharge its liabilities in the normal way of doing business. That is the going concern. How many marks? 4 marks. Are they 4 marks? These are just 2 marks. 2 marks. 2 marks. 2 marks. Then that is C1. C2, propose 4 responsibilities of auditors with respect to going concern. Responsibilities. Now, the first responsibility of auditors in respect to going concern is to gather sufficient, appropriate evidence, to gather sufficient and appropriate evidence regarding and conclude on the appropriateness of management's use of going concern basis of accounting. it's important for an auditor to ensure that he has appropriate evidence that the management has complied or prepared the financial statements based on the going concern basis. And we say that the going concern basis assumes that the financial statements are prepared on the assumption that the business will continue its operations for the foreseeable future. So that is one responsibility of auditors in respect to going concern. It's important to check if management has used the going concern basis of accounting. It should gather sufficient appropriate evidence to ascertain that the management has prepared the books on the basis of the going concern accounting, okay, in the preparation of the financial statements. Are the financial statements been prepared on the going concern basis? That's a question that the auditors should endeavor to answer, and that's the responsibility that they need to ensure that the company has prepared the financial statements based on the going concern assumption. The second responsibility is to conclude based on the audit evidence obtained whether a material uncertainty exists about the ability of the entity to continue as a going concern. That is the responsibility of the auditors, to conclude whether a material uncertainty exists, to conclude whether a material uncertainty exists, whether a material uncertainty exists about the entity's ability to continue as a going concern. The third responsibility is in relation to risk, to assess risks faced by the organization, because risks can pose a danger on the ability of an organization to continue doing business in the foreseeable future. So that is auditor's responsibility, to assess if there is any risk that the organization faces that can threaten the going concern of the company. So these are three responsibilities. Three responsibilities. How many marks? These are responsibilities of an auditor. 1, 2, 3. These are three responsibilities. Candidates were expected to give propose four responsibilities. Let's have the fourth one. The fourth responsibility is can be in relation to post-balance sheet events. The auditors have a responsibility to assess post-balance sheet events, assess post-balance sheet events. We can add another responsibility in relation to going concern is to identify factors affecting going concern. They have a responsibility to identify factors affecting going concern. The sixth responsibility can be report to the audit committee. Report to the audit committee. The auditors have a responsibility to report to the audit committee if or if the auditor believes that the going concern assumption has not been used appropriately. These are additional responsibilities. Additional responsibilities. So any 4 here would earn the 4 marks. That's part C. Part D, discuss 4 ways an internal audit function of a government entity would achieve independence in conduct of its function in relation to the internal audit guidelines for national government entities in your country. D, what is the question? Ways an internal audit function would achieve independence. Ways an internal audit function would achieve independence. We'll begin with the head. The head of the internal audit function, the head of the internal audit function should report administratively to the accounting officer. The head of the internal audit function should report administratively to the accounting officer of the entity and functionally to the audit committee. And functionally to the audit committee. For example, candidate, when it comes to matters of administration, like availability of resources, staffing, and so on, those functions can be, the head of the internal audit function can liaise with the accounting officer. But when it comes to performance of the function of the internal audit function, then the head of the internal audit function should report to the audit committee. By doing that, then the internal audit function would achieve independence, The second way in which internal audit function can achieve independence is that the accounting officer should ensure that the organizational structure of the internal audit function facilitates the entity to accomplish its internal audit functions, okay, or responsibilities. The accounting officer, here we've said that the head of the internal audit function should report administratively to the accounting officer. The second point is that if the internal audit function is to achieve independence, then this accounting officer should ensure that the internal audit function is facilitated, it is staffed, resources are made available, the organization structure, okay, is the administrative structure of the internal audit function facilitates the entity to accomplish its responsibilities. Another point is that another way in which an internal audit function would achieve independence is that the internal auditor should have unrestricted and prompt access to all records. Unrestricted should have unrestricted and prompt access to all records. The internal audit function can be independent if it has not just unrestricted but also prompt access to all records. Prompt access to all records. The third way, number 3, the third way in which the internal audit function can function independently is that the internal auditor shall respect the confidential nature of information and use such information with discretion and only insofar as it is relevant to reach an audit, internal audit opinion. This is in relation to confidential information. Confidential information. Confidential information. Another way is that all internal audit activities should remain free of influence. Free of influence. Should remain free of influence. All the activities of the internal audit function should be free of influence by any element in the organization, including matters of audit selection, matters of scope, matters of procedures, matters of frequency, timing, and also report content in order to permit maintenance of an independent and objective mental attitude that is necessary in rendering reports. So these are ways, 4 ways in which audit function of a government entity would achieve independence. 4 marks. 4 ways, 4 marks. 1, 2, 3, 4. 4 marks. 4 marks. Thank you, candidates, for attending today's session. We've answered question number 2 that was done in September 2021. In our next session, we are going to answer question number 3, which is again in 3 parts, A, B, and C. Make sure you attempt it before attending our next session. God bless you. Bye-bye.
Welcome to Manifested Publishers.
Hello learners, welcome back to Manifested e-learning platform. We are still continuing our previous lesson on reading and reading comprehension. The title of the comprehension was Gathoni's grandfather. So in our previous lesson, you were learning about the vocabulary words, the words that will meet in the story and their meanings. You are supposed to understand the words first before we read them in the comprehension. So for this lesson, we are now going to read the story. So make sure that you are paying attention, and you will also, because at the end of this lesson, I will require you to answer questions about the story. Now, as we said earlier, that the title of the comprehension is about Gathoni's grandfather. Therefore, the story is all about a grandfather who belongs to a child called Gathoni. So Gathoni's grandfather. Gathoni came from a large family. She had many brothers, sisters, uncles, aunts, and cousins. However, in school, Gathoni used to hear her friends talking about their grandparents. She had never met her grandparents. One day, Gathoni asked her father, "Father, do I have grandparents?" "Your grandparents are my parents and the parents of your mother. Sadly, they died when your mother and I were still children." Gathoni felt a little sad. "Can you tell me something about them?" This question led to an interesting conversation. I will tell you about one of your grandfathers, that is my father. Her father said. Nobody knows where he came from. He just arrived at my grandfather's home one morning. Just like that? Asked Gadoni. Yes, just like that, her father said. He was a young boy and he did not know the name of his parents. He did not even know his own name. Nobody was able to find out where he came from. My grandfather, who is your great-grandfather, guessed that the boy was an orphan, so he welcomed him into his home. What did people call him? Asked Gadoni, with a lot of curiosity. Her father explained that since the boy did not know his name, the villagers said they would look for a name for him. In the meantime, he was given duties, looking after goats and sheep during the weekends. After a short time, the goats and sheep increased in number. One member of the clan said that they should call him Nyingi. Nyingi is a Swahili word that means many. Nyingi became his name, and my grandfather adopted him as his son. Thank you for the information. I will look for more information about family in my encyclopedia, said Gadoni. So I'm going to read the story once more as we learn more about few concepts that are arising from the story. Now, the title of the story is Gadoni's grandfather. Therefore, we are going to learn more about Gadoni's grandfather. So, Gadoni came from a large family. She had many brothers, sisters, uncles, aunts, and cousins. However, in school, Gadoni used to hear her friends talking about their grandparents. She had never met her grandparents. Now, in the first part of the story, we are now introduced to Gadoni's family. The writer is telling us Gadoni came from a large family where she had brothers, sisters, uncles, and aunts and cousins. But Gadoni did not have grandparents. She only came to learn about grandparents from her friends at school. Sometimes we learn things from friends. When you are at school, there are things you do not know when you are at home. But when your friends are talking about them, you now want to know more about that. So it is the same case with Gadoni. She had her friends talk about their grandparents at school, and she had never met her grandparents. Let's see what happened next. So one day, Gadoni asked her father, "Father, do I have grandparents?" Now Gadoni has now made a step ahead. She has gone to ask her father about the whereabouts of his grandparents because she has never met them. Your grandparents are my parents and the parents of your mother. Sadly, they died when your mother and I were still children. Now we see Gadoni's father is now telling Gadoni about the grandparents. He's telling Gadoni that the grandparents are his parents and also the parents of Gadoni's mother. That tells us that grandparents are the parents of either your mother or your father. So Gadoni's father continues by telling her that the parents died long time ago when Gadoni's father and